How to value your IRA investment. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. One of the few questions I get that essentially characterize a lot of people's questions about self-directed IRAs, from individuals to the IRS, is how the heck do you value alternative asset investments in a retirement account? Well, it's a great question. And as a custodian, IRA Financial Trust is a regulated trust company that custodies alternative assets for retirement accounts. The valuation of our clients' assets is super important to us, to them, and of course, to the IRS. So why does the IRS care about value? Well, think about this. It only and always comes down to one thing: money. In the case of a pretax IRA, when someone hits the age of required minimum distributions, or 72, you have to take out a percentage of your retirement account as a taxable distribution. It's approximately 3% or so. That is money to the Treasury, but the percentage is based off the value of your IRA. So the IRS is super focused on making sure that taxpayers have accurate valuations for their IRA. Now, for a Roth IRA, the valuation isn't as relevant today because it's a tax-free account. So even if the account's 1.6 million at 72 or 1.2 million, doesn't matter. There's no tax so long as the Roth has been open 5 years and the Roth IRA holders at least 59.5. So the value isn't as relevant. We still take it super seriously, but from an IRS standpoint, the value of the Roth IRA isn't as important so long as you're not taking a taxable distribution. On the flip side, if you are under 59.5 and the Roth hasn't been open 5 years and you pull money out of the Roth IRA, it's subject to tax. Now, cash is easy to value. Cash is cash. But what happens if you do an in-kind distribution of real estate or private stock? The IRS is super interested in what that value is because, hey, the value of that asset is going to determine how much tax you pay. So valuation, even in a Roth IRA, can be relevant, especially if it's a taxable distribution setting. So the IRS doesn't prescribe any specific valuation formula for retirement accounts. Basically, it's up to the individual to provide the value. So as a trust company, IRA Financial, we don't value assets. Okay, we simply facilitate investments and do IRS reporting. You, as the self-directed IRA investor, must provide us a value. Now, we are more focused on valuation when two events occur: required minimum distribution or taxable distribution. Okay. Again, why? Because that is going to create a tax event. And we want to make sure that if the IRS audits you or us, we have some documentation and independent verification of the value. So how do you value an asset? Again, if you are under 72 years old in a pre-tax IRA, or you're not taking an in-kind distribution, the valuation is important, but not as significant. So some people use, if it's real estate, what the tax records are. Some people will get an independent letter from a realtor. You don't need to spend $50,000 on a Price Waterhouse PwC independent valuation if you have an asset and you're 55 and it's just staying in your IRA. You could essentially use an independent source, whether it's online or a third party, to provide us a valuation. And in fact, if you don't give us a valuation, we're going to use the valuation that we have on file for you, essentially potentially what you paid for it. So we're not as concerned from a valuation standpoint if it's not a taxable event. We still want to get an accurate valuation, don't get me wrong, but it becomes even more paramount to have an accurate valuation if it's a taxable event, such as a required minimum distribution or an in-kind distribution. So in those cases, we're going to require an independent valuation, someone to sign the valuation form. You'll be able to go on our app and simply include the valuation of your asset. If it's a taxable event, again, we're going to want a third party to acknowledge verification of that valuation. And again, you don't need to spend $50,000 on a valuation, but you need to have an independent person prescribe a fair market value to the asset. If it's cryptos, it's easy. Gold, it's easy. There's all spot daily valuation prices for those assets. Private stock, more difficult. Real estate, not as difficult because there's now a number of wonderful online sources where you can get very, very accurate valuations of real estate. But again, there are real estate projects that are more difficult to value: private stocks, private investments, some hedge funds, some private equity funds, venture capital funds may not give you a mark-to-market valuation on an annual basis. Some will, some won't. So those become difficult. And that's the IRS's focus. They've been really focused on valuation, almost, I would say, more than prohibited transactions. They are more focused on valuations because they feel there's more abuse on valuations than prohibited transactions. They feel strongly that people understand the rules and they're not just taking their IRA and buying their spouse a Rolex watch or buying themselves a Mercedes. They understand that abuse is very minimal. They're more concerned where someone is shifting stock of a private company, maybe undervalued, to their Roth IRA, or maybe shifting or doing conversions of assets that are undervalued to their Roth IRA. So they're more focused on that. There is a recent Government Accountability Office report that spoke to that. We've seen recently with Peter Thiel and his $1 billion Roth IRA, the Democrats, especially Senator Wyden of the Senate Finance Committee, are really focused on valuation. This potentially goes to a Roth cap. They're very worried that people are stuffing their Roth IRAs with undervalued assets, even though they do have a listed transaction on Roth IRAs. So if you do a type of stuffing transaction into a Roth IRA of business stock, you are supposed to report it to the IRS. They're still not sure that that is sufficient. So bottom line, valuations are important. You want to be accurate. There's no prescribed method by the IRS. If it's not a taxable event, not an RMD, not a taxable in-kind distribution, you don't have to go overboard. Just get us a valuation that's independent and accurate. If it is an RMD situation or a taxable event, you need to give us a third-party valuation. The IRS doesn't have to buy it, but we're going to need it, and it's going to have to be independent and obviously fair and reasonable and accurate. So not super difficult. You don't need to go and spend lots and lots of money on an annual basis. A lot of traditional financial advisors scare their clients into not doing alternative assets for a self-directed IRA, claiming that you need to spend thousands of dollars of annual valuations each year if you own real estate or a private stock. It's not true. But if you are going to take a taxable distribution of that in-kind stock, for example, or you're over 72, you're going to need to put more effort into that valuation and get us something independent that is actually signed by an independent person prescribing the value and attesting to the value of that asset. So I hope this was helpful. There's a lot of questions and valuations. Again, whether it's from financial advisors trying to prescribe people not to set up self-directed retirement accounts, or from the IRS. It's not complex. It just needs to be accurate. It doesn't need to be super sophisticated. Key is just to get a fair, reasonable, and fair market value for your IRA, especially if you're doing a required minimum distribution or an in-kind taxable distribution.